Good morning and welcome to the June 26th edition of the Gold, Goats, and Guns Market Report. My name's Tom Luongo. I hope you're all having a great day. Today we're going to do something a little different. I'm not going to go over the headlines and geopolitics like you normally do. Got a specific question from a subscriber that I want to cover. So today's charts will be more forward-thinking, more projection, more kind of longer-term discussion. So, with all that said, I want to give a shout out to all new patrons and all of that stuff. Really do appreciate everybody's grand support. FYI, if you're not a regular member over at our or contributor over at our private Slack server, we have been frankly killing it in the crypto and money forums. I can say that the guys who are active there right now are incredibly dialed in and providing just excellent commentary for the community and for me and for everybody else. So a real asset to the community and to all the patrons here as well. So just something to remind you all of what you're missing out on. All right, let's move on to what we're going to talk about today. We don't have a lot to talk about today because we're talking about gold. We're talking about the potential for a new gold bull market. And it's a thing that we've been handicapping here for a long time, and it's here, and now we have to deal with it. So I'm not going to spend a lot of time here on the commentary slide. I'm going to go mostly right to the charts, but I do want to say that part of what was asked of me was to go into what do I think about the current gold bull market. Has it started? How long is it going to last? What are the price projections for it? And what do we do in terms of buying physical gold? Specifically, how do I feel about specific gold bars? Well, I'm going to answer the last thing first because the rest of it, we all talk about in the charts. So let's start with the basics. If you're buying gold and silver bullion, I think this comment came out of some of the discussions I've had recently on my YouTube channel in the live streams. Because I know I was asked by somebody recently. So, what do you recommend in buying? If you're buying physical gold, what do you recommend? And I get this question asked of me regularly, and it's always a good comment. It's always a good topic to readdress, right, on a kind of regular basis. And you know me, I have to be prompted to do that because I'm always looking ahead, right? I'm never looking behind me. I always have that line from the movie Patton in my head. I don't like to claim the same real estate twice. I've presented that argument already. I don't want to do that again. But I know that repetition is the soul of understanding. So it is a failing of mine. So it's good for you guys to remind me to go back to the basics every once in a while because I won't do it as a natural matter of course. So speaking about buying gold bullion and whatnot, I know I know I did at least one video on the YouTube channel. I'll see if I can dig up the link to it in when I go to put this up on Patreon. But that I've done this in the past and I've talked about this in the past. But let's talk about it right now. So what do I recommend? There's a couple of things. Let's start with tax issues. Gold is still taxed as if it's on capital gains as if it's a collectible or a luxury item. I think it's collectible is the actual classification, and therefore is subject to 28% capital gains tax at all times. So it's not considered a stock or a commodity or anything along those lines, which is subject to 10% long-term capital gains, or it's subject to a much higher capital gains tax. And this is done on purpose in order to retard investment in gold, and it's certainly in physical gold. But at the same time, then the question comes into what would be considered a taxable event. When you go to sell your gold, are you going to be issued a 1099 and all of this other, in order to then have to claim those and be, on the hook to actually claim all of those capital gains? That's a murkier story, and I'm not going to tell you what you should or should not do here because that's not my business, and I can't advise you on that. I'm not allowed, and I don't really think I should, regardless of of whether I'm allowed by SEC regulations to do so or not. What I say is, as always, consult your financial professional. Let them interpret the tax laws for you and give you the best advice relative to your position and your time. Okay, but there are specific types and lots of gold that when you sell them in specific, you sell specific instruments or specific coins at specific quantities, then those are absolutely going to issue a 1099. Okay? And those are easily looked up on the internet. And it really comes down to whatever has a futures contract written against it here in the United States. Okay? So like 400 ounce gold bars, you're going to get a 1099, right? Because that's what trades on the COMEX, or right? So whatever the delivery is of that particular contract. I know that there's issues potentially with Canadian Maple Leafs and others. So when I advise people to buy physical gold, first thing I always tell them is buy Gold Eagles, because one, they're the most liquid and they carry the lowest premium. 1 ounce Gold Eagles are going to give you the best price per ounce of new issued coins on the market. Now, that's not to say that going after old coins, like Mexican pesos or British sovereigns or Krugerrands or whatever. Well, no, Krugerrands I think actually have a potential taxable event against them as well. But understand that that there's great potential for old old Swiss francs or old French roosters or whatnot, that you can find great deals on those when they're in high supply. Okay. But in general, on a day-to-day basis, you're going to find the best price is going to come when you buy a 1 ounce gold eagle. It's about as liquid as a gold coin gets, and that's that. And so for that reason, I do recommend them to people. Now, if you're not someone who has $1,500 laying around today, and you only have $300 laying around or $500 laying around at the end of the month, or you have human amounts of money laying around in your disposable monthly income, or your what you save every month, if that's the way you want to approach this, well, then you're going to get less of a good deal on a price per ounce basis, but you're also going to get the opportunity to buy fractional denominated coins, meaning fractions of an ounce, which may carry, which will definitely carry a higher minting premium along with them. Certainly if it comes from the Perth Mint in Australia, or something like Chinese pandas and others, where these are beautiful coins and they carry a slightly higher minting premium than American Gold Eagles do, which which relatively speaking are ugly, but they're functional, right? They're not designed to be beautiful. They're designed to be functional, everyday walk-in coins, right? Though nobody walks around with a 1 ounce gold coin in their pocket anymore. So, and because of that, you'll spend a little bit more money per ounce, and so you won't get, because of the amount of money it costs to print a 1/4 ounce coin is exactly this. It's very close to the same that it costs to produce a 1 ounce coin. So if it's $40, whatever the minting premium is, $50 for a, or let's not even call it that. Let's call it, it's $15. This is really closer to $10 or $15. The minting premium on a 1 ounce coin, it's going to carry that $15 is going to carry itself into a 1/4 ounce coin. So you're going to pay, as opposed to paying, say, $14.80 today or $14.75 or whatever the spot price is for 1 ounce Gold Eagles on APMEX, and that's who I recommend you buy from. You may pay, as opposed to paying $14.75 an ounce for a 1 ounce coin, you'll pay $1,500 or $1,510 for a 1/4 ounce coin. But here's the thing: 1/4 ounce coins generally are minted in far fewer quantities, and therefore over time have a much higher potential for numismatic value to collectors, because they only minted 1,000, 2012 1/4 ounce Gold Eagles. Only 1,000 of them out there, and if there's 5,000 people bidding for them, looking for them, then you could easily see them spike to $2,000, $3,000 an ounce, especially if they're high grade or whatever. But I don't recommend you plan for that. I recommend that you think in those terms when you're buying coins, and then just go, I don't care that I paid an extra $5 for this coin, because at the end of the day, I'm going to get that minting premium back anyway, one. And two, I'm thinking about trading this at a much higher price in the future. Therefore, do I really care that I paid, $3.50 or, $3.50 for this quarter ounce coin, as opposed to $3.45 or $3.42? No, because you're going to sell it for $1,500, and it doesn't matter, right? And that's the thing you have to remind yourself of. I have to do it too, because I'm terrible about wanting to get the best price. I'm just crazy about this stuff. When I sit there and I'll spend 2 hours searching through AppMex. When I'm in the market to buy coins, I'll do this for hours trying to find the best price per ounce. And it's, and I have to remind myself, you don't have to do that. You could have just as easily gone in there and said, yep, I want 2 of the quarter ounce of this year's Perth Mint Lunar Series. Got coins, I don't care what they are. Give them to me. Send them in the mail. $8 to ship them. Good, I'm good to go. Thank you. Right? Pay the price. Just walk away. And that's what I should do. I never do it. Never do it. I kick myself, but I never do it. I invariably wind up doing that, but it takes me 2 hours to justify it to myself. Justify spending an extra $15. It's crazy, right? And it ties into my observation about the way the world works, that poor people are poor because they don't understand the time value of money. In that time that I wasted spending trying to decide whether I'm going to spend $15 on a couple of quarter ounce coins, I could have written an article on Seeking Alpha and made $60. Dude, stop it, or whatever. So that's the issue, and that's the thing you have to remind yourself of. Your time is worth more than that. And then there's always the possibility, because I've looked and I've seen that some of the coins that I bought back in 2003 simply because I thought they were cool, today are worth twice spot. You see them on eBay and on AppMex, and you're like, and they're buying them for insane prices over the current, but at the end of the day, it's because the print runs were so small. It's kind of like comics. So just think of it that way. You're not buying them for that purpose. You're buying it to store wealth. But if you get lucky and you hit the lottery, that, oh wow, I was there at the right moment in time and bought Sandman number 1, and I bought it for $250 and sold it for $100 at the peak. Fine, great. Same thing with gold. That's the way you kind of want to look at it. And you just look at that as found money, and you treat yourself to something nice or whatever, and you move on with your life. So that's that. Generic gold bars, which is the text of the original question to me, they'll carry no minting premium. They'll carry no minting, as minimal a minting premium as possible, and they will carry zero numismatic value into the future. It's only the quote unquote collectible coins. Okay, so if you're good with buying a slightly higher price coin, I absolutely recommend going into fractionals. I absolutely recommend going into some of the national mint coins that are out there that are designed from a collector's perspective to potentially be numismatically interesting, and understand that you're paying a little bit extra, 1, for beauty, and 2, for the minting premium, and 3, that that is something you may have to eat in the future. And if you're willing to eat that, then it's really a no-brainer. That's what I would recommend. Okay, so that's that. So now let's talk about what's actually going on in gold. And so here we are this morning, and we're still above $1,400, though we hit a high around $1,438, I think, in the cash market, the spot market the other day. And that proved to be very significant resistance. And now we're trading at about $14.08. But I noticed this morning that the euro has backed away from $1.14. And so we're still in this kind of long gold, short dollar, long euro, long gold trade. That's kind of reared its ugly head here for a little bit. And I don't know that that's reality per se, but we are coming into the end of the quarter, so there's going to be a lot of people. And even though we had quad witching day on Friday and options have all expired for the month and for the quarter, it doesn't matter. No one wants to see a quarterly close in gold above $1,400 an ounce. That matters. All right? Anybody with any kind of power does not want to see this. So they're going to try and push it back inside the box as much as possible. Whether they can get, $50, to get it below 1365 by the end of the month is a good question. And if they do, then we know that the gold bull market is not here yet, and we're going to have to wait another 3 to 6 months. Okay? But as of right now, they've got 2 days to do that. If they do it, it would be a Six Sigma event. Not that Six Sigma events to the downside over the last 8 years are not commonplace, but they are. Okay? So right now, this has been a, 2 Sigma event to the upside. Right? Looking at the numbers here. Yeah, we've had a range here of almost $140. Right? The difference between closes here is well over $100. Right? So it's nearly a 2 Sigma event in gold for the month. So it's interesting. But the farther they push this price down before Friday, the harder it will be for gold to break higher in July. But it also could easily just be kind of end of the quarter positioning that, reverses itself the minute the markets open back up in July. We'll see. I've seen a lot of false moves around the Q2 close. Oil's done it before. Gold has done it before, certainly. Where gold looks like it's on the verge of a new, and oil have both done this in the past, on a massive breakout at the end of Q2, and then markets open up on the 1st of July and bomb both markets. And you're left stunned. And everything you think you know about technical analysis goes away when the market comes in and just says, nope, sorry. The central banks dumped billions of dollars into the market and crushed it. And so they were either lying to everybody and pump and dumping it or whatever. But you understand what I mean. I don't think that's what the case what's going on here with gold. I think this is of geopolitical. I think this breakout is of geopolitical significance. I think Russia and China are possibly behind it. The 4 big black arrows on the charts should tell you that that's where strong central bank buying is coming in playing the geopolitical war game behind, against the American and European central banks and financiers. And this is serious. We're into that mode. I said I wouldn't talk very much politics today, but you do have to realize that it's very possible that with gold trading the way it is, and with the potential for oil to break hard to the upside if another incident with Iran occurs that the United States doesn't respond to. And if it does respond to, it's kind of a damned if you do, damned if you don't thing at this point. The best thing for the markets at this point is for the United States to sit on its hands to do nothing and allow Iran to, punch us in the nose a couple of times, and then hope that they get uppity and overextend themselves. But I don't think they will. I know that's the hope in the neocon and circle. I know that's what they're hoping for. I know that's what mainstream American conservatives are hoping for. They're not going to get it. They like it or not, the Iranians are too cagey for that, and they're being advised by both the Russians and the Chinese. And they're certainly not going to do it before the G20, which is this weekend. Okay, so, all right. So that's the monthly chart. We come out to the quarterly chart. As I told you before, breakouts on a weekly basis become breakouts on a monthly basis, that become breakouts on a quarterly basis are very, very interesting. Okay, and again, this back-to-back reversals were the harbinger of this rally, and I think that again, I like to keep things as simple as possible. This was a 1-bar reversal. This was a 1-bar reversal. This was a false move down, and now we're at 1400, and we slice through the historic, the supposedly unbelievably difficult resistance around the post-Brexit vote high, like it wasn't even there. And we're seeing more and more, stuff about people manipulating the gold market. So Morgan Stanley just paid their $25 million slap on the wrist to the CFTC, right? No one goes to jail, but thousands of times they have stolen money from gold investors, and no one cares because we live in a lawless we live in a lawless environment of failed institutions. And I've got some some stuff. I got some commentary brewing in my head about what's going on with the Bank of Italy, Mario Draghi's, and the confiscation of gold, of the sovereign gold and whatnot. I got that coming. I think I'm going to, when I get done with this, I think that's what I'm going to write about for Strategic Culture today. And we'll go on from there. I may actually hold that off even for the newsletter. I'm not sure. So we'll see. Okay. And then what I was mostly asked about was, what are my projections going forward? And I'm going to give you a very simple way to look at what's going on with gold. And you can see the numbers here. The last gold bull market from trough to peak took 10 years. Right? We bottomed in gold around 257 in 2001. This might be an actual bottom back in 1999. So that would be 12 years. But let's just say that, from the breakout point here and the average price here between in these years was certainly right around 260. So regardless of the actual high, the actual low itself, but just in this range around 260 an ounce, 257 an ounce. For 4 years, gold traded in a very, very tight range. And everybody was like, oh my God, the market's done, it's over. And I started buying here. I was buying silver at $4 an ounce back here. Okay, and then we look and we see this massive run up. That was a 745% increase over 10 years. And I got into gold right around 330 or so, 310, 330, something like that. So I didn't catch the whole move, but I caught most of it, right? Well, I didn't sell anything at the top, so I really just, I'm here. This is where I bought. This is what I'm holding on to, and my average buy-in price is, I'll be honest with you, is somewhere around here. So I'm okay with that. I'm okay with that. Especially since if this is the bottom of the gold bull market here in 2015, well, then we're 4 years into the next bull run, and the 2024/2025 price target would be around $7,800 an ounce. If this expansion is multiplied out here, so this was a 7-fold increase, so we take a 7-fold increase off the bottom here, and we're up around $7,800 an ounce, and that's what a lot of people are projecting. I think that's honestly what even Martin Armstrong would be willing to project at this point. I think he's always bad-mouthing gold. He's always talking down the potential for it, even when it's breaking out, even when it's working. He says, oh, well, we still got to work. I mean, I was reading his latest commentary when we got to 1432 the other day, and he still couldn't bring himself to say that anything was bullish. I'm like, come on, man. You said we needed a monthly close of about 1362, and now you're moving the goalposts and saying we need 1490 or 1392 or 1432 in order to really confirm this. I'm like, really? You're telling me that the computer's the only thing telling you what your opinion is? My ass. Okay? Because I got you on record 2 weeks ago saying 1362. Now we're here, and you don't want to believe it. The truth of the matter is that as I showed you on the chart here, now when you really just strip out all the bullshit, this was a 1-bar reversal when the Fed changed policy. Period. The Fed changed policy. The United States backed off on sanctioning China in a trade war back then, and everybody went, Trump's not freaking serious about this, and they started buying gold. And the Fed doesn't have a clue, and the ECB doesn't have a clue, and everybody's insane. And this is where we are. And we went from 1180 to 1420 in just over 6 months. Because this Q4 number, this rise here, is mostly right in the end of December. So there you go. All right, so $7,800 on a minimum, but this original run-up from here to here was the breaking of the monetary system, right? The monetary system broke in 2008. Now we're going to break the central banks. So the reality here is that if the central banks break and all the institutions fail, then we'll see gold traded around $7,800 an ounce, and then they'll revalue the dollar. And gold will never trade at a price of nominally any higher than $7,800 an ounce. Pick a number, $5,000, $7,000, whatever it is. But then they'll do it. But then there will be a different. There will be a different system. At which point, gold will be there, but everybody else's dollars will be destroyed. Kind of like what FDR did back in 35 or 33, where the gold was just revalued from $20 to $35 an ounce, which is, in my mind, the greatest hyperinflation. It's one of the greatest hyperinflations of all time. Overnight, there was a 75% devaluation of the dollar, or in 1 month. So it was like 3 weeks or whatever it was. So projecting that out, it's like 65,000% inflation, annualized. But again, it's not talked about that way. It's certainly not talked about by Martin Armstrong that way. It's like, there's your hyperinflation. We went through it during a deflation. We were in a deflationary spiral. They hyperinflated the dollar. That's what they did. And they wiped out dollar-based investors. So, sorry about that. So, here we are. I really didn't believe that Slack would do something like that. So, that's our price target, minimum. But I think we could even see a multiple of that, because now I'm going to move on to, so now let's talk about silver. Because everybody's worried about, I know a lot of people are worried about silver, but let's just look at the silver. This is still a downtrend. There's nothing good here. We keep getting lower highs, lower lows, and we haven't gotten a new higher high yet. And we had a breakout, and then it failed. Now, yeah, we did get a higher low here. So this is the first higher low we've seen, and we're finally going to get a reversal here that's not off of a lower low. That's a good sign. But you'll notice that we had the opportunity for that here, and it failed back in early 2018, right? So here's a spike low that was higher than this low, right? But then look at what happened. Silver couldn't close above that high and force a reversal bar. And then what happened? It collapsed immediately after that. And then traded sideways, and then it collapsed again. And now we got a nice 1 bar reversal and a nice big run from 14 up to 1650. A lot of short covering over a 3-month period, and then it collapses again. Now, if this is a new confirmed bottom and it holds and it doesn't reverse immediately in July or August, well, then we can finally say that silver is probably beginning to firm up and become, an asset worth investing in. And for those of you who are long silver and long for a long time, and I am one of them, I've been holding my silver but again, I'm in my average price buying on silver is like $7. Right? I bought most of my silver at $4.50 to $5. Now, I don't say that to put my dick on the table and say, I was just in this very, very early, and I made the mistake of not selling most of it at the top of the market. I sold a little bit of it at the top of the market, but I didn't sell nearly enough of it. I should have sold it all. But it didn't, and there we are. So, silver's not ready yet. That also means that gold may not be ready, that we may see a failure here. If there's a liquidity crisis, we could see gold, pop back below this resistance line. It's possible. We could even see it retest this resistance line in this area. I actually would hope that it would do that. Frankly, sometimes drawing lines on charts is just dumb, because the market, because these candles tell you an awful lot if you're willing to look at them. All right, so that's silver. So now let's talk about Bitcoin, because my projections on gold also hinge on my projections for Bitcoin. Because on Sunday I told you watch the 12,000 level, because there was the potential here for these two monthly highs to act as resistance, and they did for about 12 hours, maybe 6, more like 6. Maybe 3. I don't know. We were talking about it in real time yesterday or the day before. It's like, Jesus. And now we have to watch the all-time monthly closing price of $13,850. Bitcoin in 3 months has retraced the entire bear market. Now, is it a pump and dump? Or is it a massive safe haven trade? And because it's so scarce, and because there's so little of it out there, the price moves and takes everybody with it. Now, this is the number you want to watch for. $13,850 and change. on a monthly closing basis. I don't think we'll get there by Sunday, though I got 5 days, and in Bitcoin that's a lifetime at this point. One bad piece of news coming out of anybody, and Bitcoin goes to 15,000 and closes the month at 15,000, which will take gold well back above 1,400. Okay, so now let's talk about Ethereum. Now, as I said, this is kind of part of my my kind of survey of the crypto space, and it helps that this way I get to build charts, and I have the charts in my portfolio, so I can just pull them out and update them now. So, pulled out the weekly chart of Ethereum because I took it out of our portfolio probably at the exact wrong time, but what else is new? And comparing it to the Dash and Bitcoin consolidations, looking at the bottom on Ethereum, this is what you want to look for. Okay, so we get a bottom, we get a reversal, right? 2-bar reversal off this bottom. So then, and that turns into a 3-week uptrend, but that's immediately reversed here. And this, we didn't see this behavior in Bitcoin, Dash, Litecoin. None of them did this. None of the coins that I've looked at so far have had any kind of sincere weakness after getting a bottom. Also, remember, most of those coins did a 1-week spike up, or certain Bitcoin did a 1-week spike up. Dash did a 2-week spike up. It took Ethereum 3 weeks, and then it collapsed, and then traded below both of these lows. And so that's a noisier base. I'm not saying it's bad. I'm just saying this is charting the difference here between them and how this played itself out and why it took longer for Ethereum to really begin to prove that it was a bull market. Didn't happen, honestly, until right here. I would have been skeptical of Ethereum all the way to $200 because of this breakdown and this rally, unable to close above these highs, and then this consolidation would have made me interested. And then again, we had a breakout, and we had an impulse bar up, couldn't break above these highs, and then we traded above, traded here. We finally got a moment where we way out here in April that this stair-step pattern was actually not effectively, a flat top triangle. Because if you draw a line here from this bar all the way across, this bar, and then here's your resistance area. So the bottom, the lows here, this high, are all in the same band right here. We didn't actually start to get any kind of signal of strength. This bar was actually the most interesting until 8 weeks ago. And now it's off and running. So it's built a base, and it's a very strong base, but it's a noisier base. And it was a less committed base than we saw in the altcoins. And that's fundamentally because Ethereum is a different product. It's not a coin. It's an applications platform. And so it should trade differently. And now that, and if I was looking at this 2 weeks ago, I would have said, watch the 300 area. Watch 295, because we've got resistance. We'd have resistance here. Sliced right through that. We didn't even approach it, but then I think it approached it right here once and then traded, kind of a flag pattern here, consolidated for 4 weeks, and then boom. And now we're looking at 490. And I pulled this one out because I just, at the end of the day, with certainly with the cryptos, you kind of have to discount some of the noise. So these 3 peaks here are, to me, are considered like the area of potential resistance. The same thing here. These peaks here. This is actually a lot less noisy, and I picked this one. And notice I picked the close here, not the actual high, because I think this is the month. I think this is the weekly closing price that matters the most. This is where it proved it can actually, hold that area after this huge downtrend here. It's the same thing. You want to look at this area in here. I'm thinking 495 to 510. So right at the 500 area. So Ethereum could easily run here if Bitcoin continues to run. Ethereum could easily run the 500. And like I said, and this morning, FYI, Dash is trading above its near-term resistance which was at 175. It's trading at 182. Dash looks very strong here. Litecoin looks very strong. And once Bitcoin peaks, you're going to see a rotation trade into some of these guys. While the profit taking will come out of Bitcoin, a lot of it will leak into the highest quality altcoins, and some of it will leak back into the dollar or Tether or whatever. Okay. Now the Dow. So we're almost done. This is the last one for the morning. So now the Dow. Last week we got a high close above the previous all-time high, and this week we've got low volatility consolidation. And again, not surprised. This market is really uncommitted to a new bull market in equities, given the situation. But it's here. It's still here. It's noisy and it's ugly and it's kind of, you can almost say that it's like a bullhorn pattern, slightly higher highs, lower lows, and that's never a good sign. The volatility is increasing, but at the same time, this refuses to give up, and the credit cycle hasn't turned negative yet. So there's a very big potential for money to move in here and push this higher on any bad news coming out of Europe. It's all going to be about Europe. Again, it's not going to be about the United States. Markets want to think that they're reacting to stuff about the United States, but it's not. Okay. It's actually the offshore dollar markets are far more interesting. All right. So that's what I've got for this week. I hope that was informative and useful to you. Again, you have other people have questions. If you have questions, don't hesitate. Send me a mail, send me a DM, send me a poke here or there. I will try to remember to catch them all. It is not the easiest thing in the world because I have like 5 different platforms to check, but that's on the burden's on me to have better operations. So I'm okay with that. Send me whatever you want. I'll talk to you about it. All right, you guys have a great day. We'll talk soon. We'll talk Sunday. Keep your stick on the ice.